Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. There are so many cross-currents in markets right now, from Fed hikes to the Russia-Ukraine war to the end of restrictions around COVID. We've therefore upped our analysis and we're providing more actionable investment ideas than ever before. In that context, we've released a new asset allocation piece where I go through what are the best markets to be over or underweight in. My focus in this latest report is on which asset should perform well when the Fed is hiking rates. We'll be updating this on a regular basis. We've also had great feedback on our US recession model, which we're now releasing on a weekly basis. The latest update is giving a 50% chance of a US recession in the next 12 months. On crypto, we look into where Ethereum could get to in the next few years. Hint, it's much higher than current levels. Then on the educational side, we summarize the academic literature on the impact of sanctions on countries. They don't work as well as you'll think. And we have an explainer on the Baltic Dry Index. This measure is commonly used by sophisticated investors, but not everyone knows what it is. To get access to all of these insights, simply become a member at macrohive.com. With membership, you can get access to all of our updates, webinars, transcripts, and our member Slack room, where you can interact with the Macro Hive research team and other members all hours of the day. Membership to Macro Hive costs the same as a few weekly cappuccinos. So go to macrohive.com to sign up now. And if you're a professional or institutional investor, we have a more high-octane product that features all of my and the Macro Hive researchers' team's views, our model portfolio, trade ideas, machine learning models, and much, much more. Hit me up on Bloomberg or email me at bilal@macrohive.com. That's Bilal, B-I-L-A-L, at macrohive.com to find out more. Now, onto this episode's guest, Dominique Dwor-Frecaut. Dominique is a macro strategist based in LA. She's currently working at no other than Macro Hive. Before that, she worked at various hedge funds, including Bridgewater. Before the buy side, she worked at the New York Fed, the IMF, and the World Bank. She holds a PhD in economics from the London School of Economics. So now on to our conversation. So welcome, Dominique. It's always great to have you on the podcast show. We spoke last year and a lot has changed since then. So welcome.
Thanks, Bilal. I always enjoyed chatting with you.
Great. Well, starting with the Fed, that's really the big topic. 6 or 7 months ago, or even a year ago, the Fed seemed quite relaxed about inflation and growth and everything. And we've seen quite a dramatic sort of pivot. Recently, the Fed has hiked rates. Chairman Powell gave a speech at the beginning of this week where he sounded quite hawkish. And now the market is pricing a significant number of hikes over the course of this year. So what's your explanation of why the Fed has pivoted so much over the last 6 months?
If I could rephrase your question, Bilal, to me, the question is, why did it take so long to the Fed to react to high inflation? Because the high inflation print started exactly a year ago. And for years, the Fed has continued to buy securities, the hawkish tilt has picked up pace, but we are just going through our first hike. It's only 25 basis points. If you look at a benchmark like the Taylor rule Fed funds, it's somewhere around 7%. The actual Fed funds is 30 basis points. So to me, the interesting question is more, why did it take such a long time for the Fed to pivot? And I suspect it's because they were still, they entered the pandemic with a strong belief in inflation inertia, that there had been decades of underperforming inflation, and they expected that to continue. And that's why in August 2020, so 6 months into the pandemic, they inaugurated their new framework that was supposed to address persistent underperformance of inflation. And what I find fascinating about this persistent underperformance and the new framework is that I can't find really a good explanation from the Fed on this persistence of low inflation. So in a way, with the new framework, they try to address something without going to the root cause of it. And in that sense, they were, reacting to the proverbial last war rather than the coming one. And you know how much I love to talk about my research, my obsessions, and one of what I'm writing about this week, and which I found absolutely fascinating, is the likely impact of the Fed tightening cycle on growth. And so one of the things I discovered looking at the initial condition of each Fed tightening cycle starting in 1960. There is really a pattern there. And you can see that the Fed in the 60s and 70s is starting each tightening cycle behind the curve. But for the following 3 decades, they are starting actually well ahead of the curve. They start hiking when the Fed funds is already above the Taylor rule rate, when unemployment is above long-term unemployment, when the output gap is negative. Now, to be fair to the Fed, this could be that based on the information available at the time, they didn't realize that there was much more spare capacity than they thought. But it seems to me that...
So just to be clear, what you're saying is in the 60s and 70s, the Fed was generally behind the curve, relative to some model like the Taylor rule.
Sure.
But from the 80s onwards, they started to move ahead of the curve. So 80s, 90s, 2000s, they were ahead of the curve. And so what you're saying there is that that's one of the reasons why inflation was so low.
Exactly. And one of the reasons why they felt the need to adopt this framework. And I believe the framework probably prevented them. This new average inflation framework is probably one of the things that prevented them from reacting fast enough, and why they are so far behind the curve. And trust me, I'm not an inflation hawk. I find that, inflation expectations are suspect concept. I'm not sure if we have a concept at all. They are certainly something that is very hard to measure. But, when you get to close to double-digit inflation and the CPI, headline CPI, was last month 80 basis points. You multiply that by 12, you get to the double-digit inflation. And the reason why you might need to multiply by 12 is that, we've had a supply shock, a new supply shock with the war. So I'd argue that month-on-month CPI is more likely to go up than down. So even for someone who tends to be a dove like myself, when you get to double-digit inflation, you really need to do something about it. Otherwise, you need, this is when inflation historically has accelerated once you cross the double-digit threshold. And also you create all kinds of distortion. So there was, I think, a case to react strongly, maybe 6 months ago, and to take a much more aggressive and proactive posture once the invasion of Ukraine started. And the Fed is getting there, but it's been getting there rather slowly, and in a way that has been rather confusing for investors. Certainly, for instance, their last set of economic forecasts is fairly inconsistent, as many people have pointed out. So
okay, yeah, understood. We'll come back on to the forecast there, but it's a good point to remind everyone about the new framework that they had in 2020. It's easy to forget that we had this new average inflation targeting framework, and it's very fair that you've mentioned that that's one of the reasons why they were late to react. Do you still think they have that framework, or have they abandoned it? And the reason I ask is because if they still have that framework, then that could mean that they need to keep rates higher for longer if inflation's overshooting the other way around.
Well, yeah, or it boils down to whether you think that the reason for undershooting of inflation are still there once you get past the shocks. Because in my view, the key issue confronting the Fed at this stage is not so much, whether they need to hike now. They need to, I don't think anybody is in denial anymore. It's more, how fast will they have to cut? And which itself has to do with what happens after the spike in inflation and a very likely hard landing for the economy. So I would argue that if we are back to the old underperforming inflation regime, there is much less of a reason to keep rates high for an extended period of time.
Okay, yes. And you mentioned that the last Fed meeting, they had inconsistent forecasts. So, periodically the Fed gives its projections on inflation and growth. So why do you say it's inconsistent?
Well, it's inconsistent because first of all, they adjusted, they basically mark to market their inflation and growth forecasts. They went for a big increase in inflation above 4% by the end of the year, but they adjusted the Fed funds rate by less, which means that if you look at the real Fed funds rate or the difference between the Fed funds rate and the Taylor rule, Fed funds rate, the Taylor rule is just a simple rule of thumb that weighs, the excess of inflation and unemployment relative to trend and converts those excesses into an interest rate rule. So if you look at benchmark, which I agree, there's nothing absolute about those benchmark, but just to give an indication of where you are, the projection was for a lower real Fed funds rate or a bigger gap between the Fed funds rate and Taylor rule this time around than in December, when the inflation picture has become worse. There was a big column from Larry Summers in the Washington Post, and Summers, he likes to criticize everybody, but he made that point very forcefully. And even if he had not been Summers, any economist making those points would have strong credibility because it's just plain logic.
Yeah. So essentially what you're saying is that adjusted for inflation, the Fed within their own projections now is expecting a lower inflation-adjusted policy rate at the end of this year than they had projected at the end of the last meeting. So strangely, they've become in some ways more dovish if their worldview turns out to be correct.
Totally, and they've been called out since the meeting on that, and I think that's why on Monday we had such a hawkish speech and Q&A from Powell, which I think, by the way, was organized ahead of time. But I think it's hard to resist to those points because they are so logic and so simple. And I think the Fed is adjusting. And I think actually it's a really good news long-term for the market and the economy. Again, looking at the impact on growth of previous tightening cycles, one of the things that comes out very clearly is that the reason the recession of the early 1980s was so deep is that the Fed took such a long time to tighten. The Fed really didn't tighten in earnest until Volker was brought in. Inflation was already in the double digits. Inflation had been accelerating since the end of the first oil shock, since the mid-70s. So it took like 5 years for the Fed to get in front of the curve. And that was devastating for the economy. I think we would all be much better served if the Fed was proactive. And we are getting signals from Powell that this may well be the case this time around.
Yeah. And you mentioned Volker. He's in some ways the the gold standard of central bankers when it comes to dealing with inflation. What do you make of Powell then? Because it does seem like, at least from the communication perspective, he's how should I say it politely, he struggled a bit. I mean, if you had to give a report card to him, if you were his teacher or headmaster or something, how would you grade him?
So, I mean, I'm going to preface my grading by saying that Chair Powell, like the rest of us, is trying to do the best, responding to a series of incentives. That said, I think, it probably scored a 5 out of 10, which is, what is it? It's a C. I think
It depends how generous the examiners are. Yeah, but it's not a great grade.
But I think we have a number of issues which predated Powell, but some which I'm afraid are his own. I think we have a big issue with central bank. They talk too much. There is this idea that central bank openness, transparency is a good thing. There can be too much of a good thing, because the problem with central bankers talking all the time is that they convey much more certainty on the economy than they really have. And of course, markets love to hear central bankers talk because they have become so dependent on central bank policy. So there is this issue. In general, they talk too much, but I think it's a bit worse under the Powell Fed, because we've had, for instance, FOMC members publicly discussing the finer points of their normalization strategy in public. And I think those discussions would much better take place behind closed door. And because I'm a nerd, I read things like transcripts from past Fed meetings. And in some of those meetings, you have Chair Yellen telling off, basically, her committee members and reminding them that what they say has a big market impact, economic impact, and that it's better to keep the discussions inside of the FOMC. And I wholeheartedly agree with this view. So there is that. Then I wish there was more of a framework to Chair Powell's communications. And for instance, Chair Powell, and to be fair, the surge in inflation that we are having is really a series of unfortunate events. And those of us who have kids will know what I refer to with his. It's not so. He's been a bit unlucky. However, and he's been taken to task. He's had to explain. How could you let inflation overshoot? This is a Congress that only a few months ago was praising Chair Powell to high heavens, and now he's been taken to task for his poor performance. But so his view has been that it's been basically supply shocks, and that the traditional textbook model didn't work. But what was missing, in my view, from that explanation is a demand shock. A year ago, when the administration came in with its American recovery plan, I was completely wrong-footed because I expected a much smaller plan, since the official purpose of this plan was COVID relief. And at the time, I wrote, this is not COVID relief, this is a plan to run the economy hot for an extended period of time. And I think there was a little bit of an attempt at social engineering there, because the view prevailing at the Fed, and to use a bit of a DC slang, in the blob, which is a democratic policy establishment, was that a hot economy benefited minorities and low-income Americans. So I believe the administration recovery plan was basically creating a positive demand shock. And in my view, that explains why the supply shock didn't turn out transitory per the typical textbook model where the central bank basically looks through it. So I wish Chair Powell had been a bit more forthcoming in telling us about the role played by this fiscal policy-induced supply demand shock, positive demand shock. So that's another aspect. I think the other aspect of my 5 out of 10 grade.
Okay.
Yeah.
Yeah. I mean, do central bankers ever comment on fiscal policy or not?
Well, that's the thing. They have to, they are independent, and being independent means that, they have to call a spade. And I would say in the case of the Fed, Chair Powell has been extremely careful. That said, at the beginning of last year, he called for more fiscal stimulus. He may have gotten more than what he bargained for, but he didn't make it clear at the time. And it's a pity because I think somehow it undermines the Fed credibility.
And within the Fed team, the board members or even the regional members, I mean, who do you think is the intellectual powerhouse? We had Clarida. He was, you could call the kind of the intellectual, maybe Brainard as well. Obviously, Clarida stepped down. Who would you say are the sort of intellectuals of the board that's kind of setting the theory and the frameworks?
So we have intellectuals, we have PhD economists, we have Brainard, as you mentioned, we have Williams at the New York Fed. The problem is what we need really is a PhD economist who can translate the economic view into a market view, which is a bit the holy grail, as we know. Even for us researchers, and Clarida was that. And now that Clarida has gone, there is really no one. I mean, we just have, a bunch of PhD economists sitting on top of 400 It's as many as there are in the reserve system. And I have to say, one thing that I really admire with Chair Powell is, when he says we have to be humble in our understanding of, in how we present our understanding of the economy, but I'm not seeing this same humility with the system, with the PhDs in the system. I mean, there is a sort of a monolithic view of the economy and a difficulty to say, I don't know. Which I think has informed a lot of the recent policy mistakes by the Fed, frankly.
And in terms of the new board members that were going before Congress, what's your take on the new members, assuming they all get through?
They'll probably get through. I think we are getting more PhD economists.
Okay.
Look, there's nothing wrong with being a PhD economist. I have to confess, I have one myself. I am one myself. But I think it's important to look at the data before you look at your model and use your model as a sort of a decision aid, something that may or may not throw light on the data, but you really need to keep an open mind. And the thing is, when you are in the market, as I am, you get constant feedback. If you're wrong, everybody finds out right away. So it forces you to go back and think about, what was wrong with the model, what did I miss? And the problem with academic or, academic/bureaucrats is that they rarely get that sort of feedback, if ever. There was never a questioning of the Fed, not seeing the crisis coming, of their handling of the crisis. That never happened. And not getting feedback is really bad for your learning.
Yeah. No, I hear you there. And earlier you mentioned a hard landing. You said that the Fed would hike and it would lead to a hard landing. Can you elaborate more on that? I mean, so you're actually calling for a recession?
I think so. So this is work in progress, and I do hope that our listeners will read my note on this topic. But yes, I mean, given where we are, given that, what is a supply shock? It's basically something that takes out a good chunk of the economy, takes it out of line because it's no longer profitable, right? I mean, in Europe, for instance, we are seeing truck drivers in Italy and Spain going on strike because they say we can't make money at these levels. This is what a supply shock is. So it means there are fewer goods and services to purchase in the economy. And so, the only way to reestablish balance, since supply is fairly inelastic in the short term, is to bring down demand. And that's where we get the hard landing. And also the fact that the Fed waited so long to tighten and is just starting, I think is adding to the risk of hard landing. So yeah, recession next year, end of this year, next year, is my base case. I would also add that I think the economy is going to surprise everybody by its limited resiliency. One thing which is really baffling me, and I've looked around for people making the point, my point about the labor market, which is, yes, it is true that vacancies job openings are a multiple of the people looking for a job. But if you look at actual hires as a share of job openings, it is at a historical low. It's never been so low, which means firms are advertising jobs, but they are not hiring. So, you have some categories of workers, older workers, who are complaining of not being able to find jobs, or workers complaining about not getting enough hours. And you don't see a decline in the percentage of part-time worker for involuntary reasons, which tells you that the labor market is not that tight afterwards. So my suspicion is that once we start, demand falling in earnest, we're going to discover that the market that we thought was the tightest, the labor market we thought was, super tight, actually is not that tight, and we're going to see a fast move down in growth. And so, yeah.
I was going to just ask, I mean, there are some positive signs in the economy. So people often talk about the Capex cycle seems to be quite strong. I mean, would you agree with that? And would that be enough to offset some of these other factors?
Unfortunately, no, because Capex is such a small share of GDP, and also the Capex that we have, the Capex cycle that we have, has a lot to do with automation and substituting capital to labor. And the other thing about the Capex cycle, we still don't know what the impact of the increase in corporate debt is going to be on the economy, whether there is any risk that firms could find themselves struggling to service their debt once interest rates go up. And that is going to impact, of course, Capex and demand for labor. So definitely, Capex has been a bright point, but it's too small. The US economy is a 70% consumption. So once consumption starts contracting, I don't think Capex is going, even if Capex is decoupled for consumption, because it's more about, changing the nature of how business are run. I don't think it's going to be enough to offset the contraction in consumption.
And then on the consumption side, what happened to the big services reopening kind of bounce in consumption? I mean, has that happened in the way you would have expected, or where are we on that?
Not at all. And that's one reason for pessimism, is that coming into this supply shock and into this Fed tightening cycle, we didn't have a big burst in services consumption. We could see, and you can see it with the latest number, that consumptions of goods is falling in real terms. So we have a contraction, especially durable, which makes sense because household bought so many durable during the pandemic, but the services consumption is not increasing fast enough to make up for that contraction. And when you look at it in terms of household income, you can see that real household income has been contracting for the past about 6 months, because you no longer have government transfers, and then you have inflation and wages that are not nominal wages, that are basically stable to falling. And so you have a slow but steady real household income contraction, and that's with 400,000 increase in jobs monthly. But when we go to zero, we're going to have a fairly nasty contraction. Plus, the thing that has been keeping the economy going so far is household saving much less. But the household savings rate is now well below the pre-pandemic savings rate. So probably cannot go down much further. And so that's another reason to expect a hard landing next year, because in my view, the economy is nowhere as strong as the Fed tells us it is.
I mean, could consumers dip into their stock of savings? So they're saving a lower rate of their income than before, but didn't they build up this excess savings? So they have a pot of savings that they could dip into, perhaps, which could fuel consumption. I mean, do you think that could work, or?
Then that would mean that the flow of savings would be negative, which has been very rare, hasn't happened. Savings are still the savings rate is still about between 6 and 7% of disposable income. I think some of that is happening for some of the household. So probably low-income household that were compensated the most by the government American recovery plan. I think those probably have negative savings. But on the other hand, higher income household who kept their job, because typically they had jobs that could be done from home. So those didn't have much of a dip of income in income, and kept their savings rates high. And so net, we still have a positive average household savings rate.
And so given this view that you have, high inflation now, the Fed has to hike, and then recession next year, first half next year, end of this year, what do you think will be the Fed's path then? I mean, how many hikes will they do for the rest of this year? Will they start cutting next year? I mean, how do you see the profile?
So for this year, 8 hikes are not unthinkable. I think the Fed is very much going to be driven by inflation print. So 8 is feasible. In terms of next year, I think they will be reactive to inflation. They will want to see inflation clearly back to target before easing. So one thing that this job has made me is very humble about my ability to predict the future. So a cut maybe in the latter part of next year, because based on my expectations that the decrease in growth is going to surprise everybody. So the Fed maybe could start easing at the end of next year. That's possible. So it would be a fairly short recession, but usually US recession are short, a few quarters. The reason the recession of the 70s, 80s, of the early 80s lasted so long is that the Fed dragged out the tightening for such a long time, and then in the end had to really slam the brake very hard. And I'm hoping we are not there. The scenario I'm describing is one where the Fed is proactive, and then the pain is going to be shorter. But if I'm wrong, and if we end up in a sort of a late 70s scenario in terms of Fed policy, then the recession is going to be is going to last longer.
Yeah. And you mentioned the 70s, many people are making parallels to the 70s today because we've had these oil shocks and people are talking about inflation. Do you think the 70s are a correct reference point for us or not?
Other than the oil shock, not really. First of all, really what's made a difference this time around is a positive demand shock. I mean, if you look at the monetary fiscal policy mix in the US, there has always been a tendency to not use the fiscal and over-rely on monetary policy. That's certainly what happened after the GFC. And so what really makes this episode unique is the incredible fiscal impulse we've had. Also, I think the economy is very, very different from the 70s in a structural way, in the sense that businesses have much more market power and workers much less market power than today than in the 70s. And the strange thing is the market power are translated in low inflation because of the way this monopolistic economy works. Basically, you have a few dominant firms, like say Amazon, that imposed low prices on their suppliers, and their suppliers could not find enough alternative purchaser of their goods, so they had to abide by these very low prices, and so we had market power with a strongly monopolistic economy with market power, with very high profit margins, and that sort of equilibrium was completely disturbed by the supply and demand shock. But I think we are going back to it once you are through the recession. And I think that's a big difference with the 70s.
And so presumably your longer term inflation view is not that we're entering a new higher inflation regime. So can you just kind of go through the arguments for, a low inflation regime from a structural perspective? So one is you still have market dominance by or large market power by large companies. So that's one factor, which is different from the 70s, which argues for lower structural inflation. What other arguments, would you have?
So I think really two. One is demographics. If you look at the relationship between population growth and inflation, it's actually quite strong, but it is the fertility part of the population growth that's important as a driver of inflation, more so than the dependent part. So in other words, if you do a bit of quantitative work, you see a much stronger relationship between the ratio of a young dependent in the population and inflation than between inflation and demographic growth. I hope readers will refer to one of the notes I published on this topic. There is a chart there that's quite striking. So, and population growth has collapsed. I mean, in the US, the fertility rate we had in 2020 was the lowest on record, so since the 1930s. And, there have been polls done to ask people, why are you not having more kids? And they say it's too expensive, and uncertainty, and they have no intention of having more. We're not having more children once the pandemic is over. So a post-pandemic baby boom is highly unlikely. So that's one. The second one, I think, is financialization. So what is financialization? It's when you have a stronger demand for financial assets than for economic assets. like buying more factories or even buying more consumer durables. And for the financialization is a super strong trend that reflects a number of things. So income inequality is up there because household with higher income have a higher propensity to save, and saving is basically a demand for financial assets. So, if you have, when you have high inequality, you have this inbuilt tendency for incremental income to go to purchase financial assets rather than real assets. So there is that. There is also monetary policy and QE, which in my view has been quite, I don't want to use the word disaster, but certainly has benefited Wall Street much, much more than Main Street, and added to wealth and probably income inequality. What it's done also is to juice up the return on financial assets relative to real assets. Basically, central banks have been pushing on a string to try to address structural disinflationary trends through monetary creation. And all it's done is push up financial asset values rather than raise inflation in a sustainable manner. So, and I would even argue that, intuitively, if you have low interest rates and you're trying to save to fund your retirement, obviously you have to save more. You have to save more with low interest rates than with high interest rate if you have a target retirement income. So all of those things, to me, suggest that this sort of hyperactive monetary policy that we've had has actually added to disinflation rather than raised inflation. And that policy is not going away anytime soon, certainly not with the Fed board that we're going to have. And that's one of the reasons, I think, once this cycle of inflation recession is over, we're going back to underperforming inflation.
Well, all quite sobering points that you've made here. Finally, let's just have a look at the rest of the world. I mean, when you look at, say, Europe, I mean, do you have any thoughts on Europe? Because obviously we have the war going on. There's also the energy shock that Europe's facing. We have ECB's sort of struggling to sort of lift up policy rates. I mean, what's your take on a region like Europe?
Even though I'm a European myself, well, half European and half American, I had been very skeptical of the Euro project since day one. No more. I think Putin has done more to bring Europe together than 70 years of, shindigs, think tanks, high-level meetings of all kinds. I think we have much more of a sense of political unity and common purpose on Europe. And for the first time, I am thinking that actually the euro is probably here to stay.
Okay. Wow. Quite a big statement there. Okay. Well, with that, I mean, let's wrap up the conversation. I mean, we've covered a lot of ground. You've had some quite provocative views, which is great. And what's the best way for people to follow you?
It's very simple, macrohive.com. I mean, if you don't have a subscription, you absolutely should get one. It's not just me, but there are lots of really interesting and provocative people writing there. So strongly advise our listeners to subscribe.
Great. No, appreciate that, Dominique, of course. Well, with that, thanks a lot. And then, obviously have a good rest of the week as well.
Thank you, Bilal.